Oh, it's great to have you with us this morning, and it does feel like we are at a very important point when it comes to the market's mood and what's going to happen with central bank policy. I mentioned we've got a ton of interest rate decisions coming around the globe this week, but the main event will be the U.S. Federal Reserve. Now, as I mentioned, there are very few pundits that are expecting the Fed to take action at this meeting, but increasingly, just based on what the economic data has been showing us, there is a growing view that the Fed could be ready to go in September. Of course, the Bank of Canada has already pivoted to rate cuts, a couple in the last two meetings, and there are growing expectations that we could see more ahead. It is a theme that our next two guests have talked extensively with us about in recent months, and we wanted to get their take on all things economy and interest rate related once again. David Rosenberg is the president of Rosenberg Research. Ed Devlin is the founder of Devlin Capital and a senior fellow at the CD Howe Institute and former head of Canadian Portfolio Management at PIMCO. It is great to have you both back with us. It has not been a slow summer because we are at a point in the economic cycle where everybody's been trying to figure out what happens on the interest rate front. And as I mentioned, David, you'd been pretty loudly saying you felt that cuts were going to be required on both sides of the border. But let's start with, in your opinion, where we sit right now in North America when it comes to rates.
Well, the Bank of Canada has already cut rates twice, and that's just an appetizer for the meal. And all they've done, talk about cuts. They just basically offset the policy missteps they did this time last year when they hiked twice into the, quotes, excess supply backdrop that they're now lamenting rather openly. So this wasn't even an easing. This was just basically undoing the misstep of a year ago. So it's hard to know meeting by meeting what they're going to do. I just know the destination because they've given it to us on a silver platter, because they mentioned the words excess supply not once, not twice, but thrice at last week's policy statement. And when you look at their forecast, they were even telling you that the output gap, the deflationary output gap, doesn't close, even as far as 2026. So the point I'm making is this. The midpoint of the Bank of Canada's target range on the neutral nominal rate is 2.75. We're at 4.5. At 2.75%, that neutral rate is supposed to coincide with an economy in balance, an economy that does not have a disinflationary excess supply backdrop. That's where they have to get to at a minimum. So they are really behind the curve. And it's not just me that's saying that. The inverted yield curve has been saying that for the better part of the past year. So I know the destination is that we're going to 2 3/4 at a minimum.
2 3/4 at a minimum.
Yeah.
And Ed, for you, how are you thinking of the time frame here on what the Bank of Canada does? Like, what would be the pace of cuts that you think would be likely?
Yeah, I'm with David on this one. It's giddy up time. It's time to get going. Just like they, sharply raised rates when they had unexpected inflation. It's now very clear, if you look at the monetary policy report that they just published, that there's an output gap. And even their forecasts are all deferred. Like the short term, is barely above 1% growth, and that's optimistic in my viewpoint. And so get to neutral, so get to about 2.5. Right now, the bond market has it priced at 3.5 next year. So I think there's a good 100 basis points or so still left in that kind of front end of the yield curve.
What's, in your opinion, the danger of not necessarily moving at an aggressive pace to lower interest rates?
That we're going to end up with a deeper recession that we're going to have in any event. That's already staring us in the face. It's undeniable that we've had the unemployment rate go up 160 basis points from the cycle low. John, that is 100% ironclad recession indicator, and at a time when real GDP is already running negative consistently. So looking at the bank's forecasts and looking at the fact that we have an output gap as we sit here today, and inflation and underlying inflation is falling, if they don't move quickly, then we'll be talking in the next 2 years of inflation going to zero. And remember what they said in the NPR was their big concern was inflation going back below target. Look how things have flipped over the course of the past 12, 24 months. Their concern is that inflation will fall below 2%, their target. They do nothing, inflation is going to zero in the next 12 to 24 months, and the unemployment rate if they just sit on their hands, or I'm going to say if they don't go as aggressively as I think, and by the way, I don't think getting to neutral is aggressive. I think they'll end up having to do a lot more than that. 0% inflation under their own, when you read between the lines of what they're saying, and they're not going to publish these numbers, 0% inflation. Of course, they're calling for 2 because 2 for the Bank Canada is just nirvana. The central bank will always forecast nirvana. 8% unemployment. Okay, 8% unemployment from where we are today. What, 6.4? They are as behind the economic curve today as they were behind the inflation curve 2 years ago. They just swung the pendulum the other way. So I think that most, if not all of the aggressive rate hikes that we had in 2022, 2023 are going to be unwound. And I think we're going back to where we were back in, I'm not saying we're going back to zero, okay, but I think we're going back to the levels we were at before COVID, which was, where were we, like $1.50 in the overnight rate.
And Ed, look, if you're unemployed, you're probably thinking twice about what you buy or how much you buy, and I think some of that is reflected in the data. If you're somebody who is employed and has a mortgage, I think the other thing, we have heard increasingly the Bank of Canada talk about something that a lot of people have been talking about for a long time, which is this mortgage renewal wave that we're going to see over the next few years in this country. Does that also play in to your analysis on how quickly the bank needs to cut rates?
100%. 100%. I mean, mortgages are a big chunk of our debt stock. And so the fact that, it was pretty straightforward to forecast this, right? Because mortgages, you see it, that they're out there, right? They have to be, refinanced. So yes, that is definitely it. And I'm with David. And the one thing you have to think about is a bit more strategically, and I've been talking about this for a couple of years now, is the biggest concern I have is going back to disinflation or deflation, okay? And the reason why it's just insidious is because we've got so much debt. We've got massive debt stocks, both on the government side as well as on the consumer side. And when you've got inflation at 0 or less, it means when you pay back your debt adjusted for inflation, it costs you even more. So you're not inflating away your debt, you're increasing your debt stock. And so given we've spent so much money and we have such massive debt stocks, it is really important to get rates lower to prevent that outcome, to prevent that from happening, because that happens and that's a really nasty thing to get out of. And we've seen that in many countries, including Japan.
David, all of your analysis so far has been rooted deeply in the numbers and the data, but as you know, sometimes you're painted with the bearish brush. And there are some people that have been looking at what's happening with the economy, listening to what they're hearing from the Bank of Canada and saying, well, maybe we are actually set up for a so-called soft landing scenario where inflation has been easing, the economy is holding up relatively well, even if the unemployment rate has been rising, and that has given some flexibility for the Bank of Canada to cut rates at a steady clip. There's still a conversation in the marketplace, as you know, about them maybe cutting and then waiting, and not necessarily every meeting cutting right now. So what would you say to those who say, well, it's Rosenberg?
Before or after I roll my eyes at the comment that we're in a soft landing, I mean, the U.S., with all the fiscal stimulus that they've had and the CHIPS Act and the fact that homeowners protect themselves because they have 30-year fixed rate mortgages there, we don't have that protection over here. Soft landing with the underlying trend in real GDP at 1%. People call that a soft landing today. Let me tell you something. When I started in the business on Bay Street in the mid-'80s, when we got down to 1% GDP growth, my phone would ring off the hook about when is the recession starting. And now you're talking to me 1% growth. We haven't even seen the full impact of all the damage the Bank Canada has done, and the run rate on GDP is 1%. And we have people out there talking about a soft landing. My recommendation to them is to get their head out of the sand. Okay, the only question for the next year is how deep and prolonged this recession is going to be. And that's all the Bank Canada can do right now. They just talked about, for the first time, downside risk to the economy in the monetary policy report. Downside risk to the economy, John, with the underlying trend in real GDP 1%, downside risk to 1% ergo means that we are slipping into recession under the proviso that we haven't gone into one already. And all the Bank Canada can do right now is try and contain how deep and prolonged it's going to be. So yeah, I know that sounds bearish, but here's the deal. I try to be as realistic as possible, but to talk about a soft landing at 1% growth with all the lagged rate hikes coming into the system is arguably the most ridiculous thing that I've heard.
Well, we